Planet 13 Holdings. Is PLNHF legit? Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me at StockerFinance on Twitter for more information. So recently, Planet 13's holdings stock has been on a surge, and you may have heard about it or just seen that from this massive surge that the stock has been on. In fact, in the past year, it's been up 95%. In the past 6 months, 166%. And just in the past month alone, over 80%. And as of today, it actually crossed $4 a share, up 15% today alone. So what is Planet 13 Holdings? Well, it's a cannabis company based in Nevada in the United States, and on November 1st, 2018, it opened the cannabis dispensary in Las Vegas, which actually became the largest cannabis dispensary in the world at 112,000 square feet. This is a massive facility. The company operates through Planet 13 Cannabis Superstore Entertainment Complex, but it also has a bunch of sub-brands like Medizen, Trendy, Leaf and Vine, PURC, and Planet M. The product portfolio of the brands are primarily cannabis products, while PURC apparently is a coffee brand, which is just kind of a random extension of this holdings company. So some history to this company off Wikipedia here. It's run by two CEOs, Bob Groesbeck and Larry Scheffler, who are actually former politicians, which is very interesting to go from being a mayor of Henderson as well as a councilman to then the co-CEOs of a cannabis company based in the Nevada, or based in Las Vegas, that owns the largest cannabis store in the world. Just kind of a random transition to go through there. Now, it has a cultivation license in Nevada, and along with that, it has 2 retail licenses. They sell both medical as well as recreational cannabis. The company has a retail outlet near the Las Vegas Strip, which I just talked about, and it's open 24 hours, 7 days a week. So it's always operating, which is great to see for at least for all those late nighters. So now let's go into some numbers here. We'll do some number crunching as well as just take a look at the financials of this company and see how they're doing. So its total current assets is about 24 million. Actually, it's about 30 million in property and equipment alone, which its total assets are around 66 million. Its total current liabilities, however, are just at 13.8 million. So its total current assets are about double that to its current liabilities, about 2-to-1 ratio there, which is great to see. Along with that, we're seeing its total current assets increase. We're also seeing its liabilities increase a little bit as well. Now, one thing that we got to keep in mind here is that its total liabilities, which are 24 million, are significantly less than its total assets, but they're actually increasing at a faster rate of 12.63% than its total assets, which are increasing at just 5.4% from this time period, which is about December of last year. Or let's look at this, December 31st, 2019 to March 31st, 2020 is the time period. So total liabilities are increasing faster, but again, this is one of those situations where, although it looks like it's increasing faster on a percentage basis, it is a lot easier just to go from 20 million to 24 million than it is to go from, 60 million to 66 million. So even though they actually added more money, it's just a lower percentage because the numbers are bigger. So is this something to worry about? Maybe, maybe not. You can't really tell right now until we go through some numbers and we get crunching a little more here. But it is something just to follow along with and to keep your eye on as you track this company. So keep an eye on those liabilities as well as its total assets. Now, it has 84 million total common shares. And if we do some math here to look at just some basic fundamental analysis, the current ratio is 1.73. Now, a good ratio is generally between 1 to 2. So having a 1.73 current ratio, that's pretty solid fundamental there. Now, if we do some value investing here and take kind of a Benjamin Graham approach to this company, which might seem a little abstract for a company like this, which you'll see in a second here, it is kind of abstract. And this is the net current asset value per share. So what we usually do is current assets minus total liabilities plus the preferred shares divided by total outstanding shares. However, since this company is a little bit more unique, I'm just doing total assets minus total liabilities divided by the total outstanding shares, which gives me 61 cents per share. So 61 cents is significantly less than the $4 per share that is currently trading at, which gives it around a little over a $500 million market cap. Now, this is not a value investment, though, and you've probably realized that, and if you do own shares of this company, you're probably smashing keys on your keyboard right now at me saying, David, this is not a value investment. What are you talking about? No, you're right. This is more of a high-risk growth investment. It's a newer company in terms of at least when it went public. It doesn't have a ton of stores. It just has a couple locations, although they're really big locations. It's trying to vertically integrate, which is a big part of its business. It's really just getting going, so it's not some established old company that you're trying to buy for cheap and hope that the share price, goes back up to its intrinsic value or its book value. That's not the case. It's really just a high risk growth investment is what I like to consider this. So in terms of gross profit, we're actually seeing 19% growth from this time period, from 7 million to 9 million, which is fantastic. But we are seeing 18% in terms of total expenses, from 7 million to about 8.7 million. So again, its gross profit and its total expenses are growing at just about the same rate. Gross profit growing a little bit faster, which means margins are probably staying about the same there. And a lot of that just has to do with the fact they have a lot of general and administrative expenses, as well as they're spending a lot on sales and marketing right now. So if they were to cut back on sales and marketing, or cut back some of their general administrative costs, which once they get a little more established, they probably will do, that will definitely lower their expenses and increase their bottom line there. Now, if we keep moving on here, we can tell that their loss for the period actually decreased to about 1.4 million from 1.423 million, which is great to see. And again, you got the loss decreasing there, which is a great sign to see. But accounts payable actually increased pretty substantially. Now, that is a little worrying to see, since it just about doubled the amount of money they owe to other people. But in terms of accounts payable, most likely this means that they took out a loan, or they took some product, or whatever they might have done to try and build out facilities and just grow their business more and more. That's my opinion. They're probably taking the money they got from going public, or whatever it is. They're getting loans, whatever it might be that they're doing, and then they are trying to build more facilities, trying to rapidly grow their business through marketing, whatever it might be. I don't think that's that big of a deal for this type of company that's rather new and seems to really just be getting going, especially when it has really only one location in Las Vegas right now that's fully operational. Now, its cash flow decreased slightly to about 2.4 million. This is cash flow provided by operating activities. Nothing too much to worry about there. Yeah, we can just go off to this next little thing here. It's something that I want to talk about because it's something that is a little worrying about this type of company. Now, the reason this is worrying, because these are unaudited financial statements here. Now, they're unaudited, and they say they're in accordance with, but they're still unaudited, and they're also consolidated. So they don't include, or don't have to include, all the information required for a complete set of international financial reporting standards with these financial statements. And a lot of it has to do with the fact that they're not on the NASDAQ right now. They're just an OTC traded company, which means this is an over-the-counter stock. So you're not going through the NASDAQ, you're not going through the New York Stock Exchange to purchase this. This is over-the-counter shares here. And that is something just keep in mind, that you really have to trust the integrity and the honesty of whoever is writing these financial statements, the company overall. That a lot of this might be condensed. They may be leaving some parts out here. Some information may not be included. You might be not getting a full picture of how this company is operating until they get listed on the NASDAQ, or they have to comply with these rules once they get large enough, which will happen eventually if this company keeps on growing. Now, let's look at total inventories here. It's a lot of raw material, goods, etc. Has about $1 million worth of harvested cannabis, actually an increase from the last period, from 960,000 to 1.08 million. And its total raw material is around 1.367 million. Finished goods 3.2 million, and so its total inventories increased by just over $1 million from the last period to this March 31st 2020 period. That's its total assets are growing. That's good to see that they're producing more and more, and that part of their business seems to be working quite well on a production side. Now, if we look at stage of growth here, it increased slightly. Now, I don't know too much about growing cannabis or a lot of the technicalities of it, but just by looking at numbers, I can tell some basic information here and get an idea of what's good and what's bad. So survival rate increased to 91%. That's obviously great. If more plants are surviving, then that means that they're going to getting more cannabis. It's going to cost them less money to have to regrow plants. That's a great sign there. Wholesale selling price, it increased to $5.29 from $5.08. That's actually a pretty significant jump there, and a great sign, because with that jump, it means they're going to be making more money by wholesaling their other marijuana there. So now let's go on and look at some other prepaid expenses and current assets here. Now, it actually decreased to 2.9 million as of this period. And a lot of that, which just has to do with funds waiting, clearing from payment processors. Most likely, a lot of those funds got cleared, they paid them off, and that decreased substantially, which is a great sign to see. So it decreased by a little less than $1 million in this time period. Now let's look at the lease liabilities, because this is kind of an interesting. They have about 10 million, actually 10.5 million in total lease liabilities, which increased slightly from the last quarter. However, this will probably stay the same for long periods of time, since these leases are for such, a lot of these leases are for greater than 5 years. So that's a pretty long-term lease there. As you can see, the less than 1 year leases are only 1.3 million. Greater than 5 years is over 26 million. So to have those long leases there is something that's going to be around for a long time as this company continues to grow and operate. And its lease agreements are for cultivation, manufacturing, retail, office premises, as well as vehicles. And the property lease terms range between 7 years, 21 years, depending on the facility, are subject to an average of 2 renewal periods of equal length. So it's just talking about leasing vehicles, property, construction stuff, etc., whatever it may be. But it is something to keep in mind that this company has over $10 million in just lease liabilities. And when you looked at how much money it was earning, and as well as its total liabilities, it's a pretty significant portion of those liabilities, as well as a pretty significant portion when compared to its total assets. So just something to keep in mind and something to watch out for, that it is leasing. It has, a significant amount of items leased here. Now, if we go on to some other expenses here, these are just general and administrative expenses, but the majority of it is all in salaries and wages. Now, they don't have a ton of employees, so $2 million in salaries of wages kind of seem like a lot, but at the same time, if they're paying their employees well, getting high quality workers, maybe the CEO, the co-CEOs are both taking probably similar salaries there, probably paying themselves decently. And if we see the executive compensation, it's about $279,000. So that's actually not a ton. It's not crazy. They have a lot of subcontracting going on right now in terms of building. Nothing to worry about here. If they are paying their employees well, it's great to see. They got a lot of different workers across the whole vertical integrated, types of their businesses, from the farming of the plant all the way up to the front counter worker at their dispensary. So nothing too surprising or alarming to look at here. Now, they actually have 2 locations right now. Well, technically just one. They have their one location, which is Vertically Integrated Cannabis Organization. Sorry, I don't know why I just read that sentence, but whatever. The company currently holds 6 licenses in the Nevada market, and they have this largest store there, has 2 licenses, and has 2 licenses for cultivation and 2 licenses for production. So fully vertically integrated, which is super cool to see. Now, one thing you'll notice is they're trying to build a California superstore as well, which is going to be the second largest cannabis entertainment complex. But the difference between this is it only has 2 licenses for the dispensary. You might notice that it's missing the cultivation and production. My assumption here is that they're not going to vertical integrate this dispensary. Instead, they're just going to use the same cultivation and production for this facility and just simply ship it over to California and use it in this dispensary. I may be wrong about that. There may be more details, and if I am wrong, please correct me. But that is just kind of what I've noticed about the differences between the two stores. But the fact that they're building another store, and the fact that they're able to afford this and keep growing their business is great to see. Because being a $500 million company and only having one big location, yeah, it's a huge location. I'm sure I've heard it gets a lot of foot traffic. So people are there all the time. I heard there's lines at the door. But that's a pretty hefty market cap for a company that has one location like this. To have another one and maybe to have multiple after this is going to prove to me that this brand and this company is really well liked across the United States. Maybe if they get some in Canada as well. That's going to be a bigger sign to me, and it'll kind of back up their valuation right now. Now, it was recently awarded a Nevada dispensary license, which is pretty huge. It actually had an ongoing lawsuit with the Nevada Department of Taxation as well as some other parties. And part of the settlement is that Planet 13 is receiving 1 provisional adult use dispensary license. Now, if you don't know much about the marijuana industry and the cannabis industry as a whole, getting licenses and getting regulation passed, all this stuff, it's extremely complicated. So I do think the fact that these CEOs are both previous politicians is going to be a big benefit to this company. Now, this is kind of just a press release from the company, and to quote their CEO, Larry Scheffler, he said, their co-CEO, he said, "We've been pursuing additional premium indoor cultivation to expand our Medizen flower line, including our proprietary strain Chloe. Apparently, Medizen sells out its harvest days after it hits the superstore shelves, which is great to know if he's telling the truth, and I somewhat believe him based on what I've heard about this company, is that it has a huge following, and if it has that much demand, then that's really good for this company's business. And if the agreement allows them to add up to 25,000 more square feet of indoor cultivation immediately, which means they'll be growing a lot more and able to sell a lot more, and the ability to expand actually up to 45,000 square feet in the future. So another example of Planet 13's patience and ability to execute for our shareholders. We have identified an opportunity to assume control of a fully built indoor cultivation facility at a price that will be accretive. So this is another other co-CEO. So it's funny having two co-CEOs. I sometimes get it mixed up. But they're actually paying out of pocket $3.3 million of their own money to purchase the land and building in order to preserve Planet 13's cash while offering an ongoing lease well below the rate set by cannabis REITs. So that's a great sign that these co-CEOs both care about this company, that they're putting their own money on the line in order to preserve the cash of Planet 13. Something that you really like to see there. And I don't know these co-CEOs personally. I don't know too much about them. I've just been researching this company a lot recently. But to see that's a good sign that they're putting their own money on the line. Now, what about getting added to the NASDAQ? Because that's going to be a pretty big deal to make this, company more official on the stock exchanges. So, number one, there's a bunch of different things that this company has to meet. And it actually met almost all the qualifications. So, it has shareholders' equity of at least $2 million. It has at least 100,000 shares of public float, minimum of 300 shareholders. It has that. Total assets of $4 million. Already seen. It has that. 2 market makers, has that. $3 minimum bid price. It's at $4 now, so it just met that. Public float market value of $1 million. It has that as well. Now, it actually has to hit 3 straight profitable quarters as well, which is the next I think the last qualification that it needs to meet. However, there's also tons of legalities and licensing and banking regulations that this company needs to go through in order to get added to the NASDAQ because it is a cannabis stock. So that's going to be some difficult. It's going to be a long process. I don't expect it to get added to the NASDAQ anytime soon. If it does, it'll surprise me, and that's awesome for this company because it's going to get a lot more funding. Its market cap will increase substantially, and it'll be able to expand its business and grow a lot faster than it is right now, even though it's still growing pretty quickly. So anyways, thanks for watching. Please subscribe. I'm kind of mixed on this company. I think it's growing, but I think it's still in its early stages. I think it's starting to snowball. It's building out facilities. It's investing a lot in itself, and it's great to see. Its liabilities are growing a little quickly, but again, that's kind of what happens when you're spending a lot of money on different equipment, getting leases, whatever it might be to grow your business substantially, loans. You have debt, a lot of different things going on. The vertical integration is something that I really like to see, and I similar to Tesla, how it vertically integrates, this company vertically integrating just totally makes sense to me. Growing the weed and just having it right there for your pot shop. The fact that it appears they have a lot of demand and that they're opening another store in California, or another superstore, I guess, in California, which is a great sign that they have the cash and the ability to do that right now, is a great sign for this company. And I think California is a great place to do it as well. Anyways, thanks for watching. Please subscribe. I hope you enjoyed this analysis of Planet 13 Holdings Inc. Please check out these videos and follow on Twitter at StockerFinance. And I'll see you guys in the next video. Peace out.